Welcome, everybody, and thanks for being here. So today, I'm Pietro Garibaldi, as I'm here as host and the director of LTI. So we're here for the fifth presentation of LTI report, which comes with a conference, and I will discuss in a few seconds the program of today. So we will be around two and a half hours together. So let me just remind you, so we are in Fondazione Collegio Carlo Alberto in Torino, because there is true that there is another Collegio Carlo Alberto where we actually were in Moncalieri, and one of the hosts said that he was about to go to Moncalieri. Anyway, so it's a pleasure to be here. So LTI, it's a young research center, which is now 7-8 years old, which is established by the University of Torino, and with key financial player from the northwest of the region, which I will now name them, and is hosted here in the Collegio Carlo Alberto, which is a large foundation between the university and Compagnia di San Paolo, and it's part of the finance part of the Collegio. The Collegio focus on social science in a broad sense, and in the finance issue, one of the pillars is LTI, which has a mandate to study policy and research issues on long-term investors. So its feature is that it has a well-defined mission, and that's what we are trying to do. And by fostering research, policy-relevant issues, and also a bit of continuing education. So this is what LTI does, but it can exist thanks to, as I was saying, to our sponsors, which are Compagnia di San Paolo, which is also one of the main founder of the Collegio, Equiter, Ercel, Fondaco, Intesa San Paolo, and Reale Mutua. So thanks to all of them for the continuing support. Now, the flagship publication, what we do is this LTI report, which is now at the 5th edition, is joint. It's produced jointly by the LTI and then published by the CPR. The CPR is the largest European network of economists. And the idea of the LTI report is to ask to establish a senior scholar in the area of finance in a broad sense to basically disseminate their research agenda, their research finding in an accessible report. And it's very important for the academic profession at some point, and for any academic scholar at some point, to try to basically disseminate in non-technical ways the finding of the research. So in the years, we had many distinguished scholars, and we touched on private equity with low interest rates, the role of SGE, the second report. Then we had bank disaster and bank financings, which we're talking last night with Ongina and co-authors. Last year we had PPI. And this year we are in one of the hottest topic that is around, which is basically, can blockchain decentralize money, contracts, and markets? And we have 3 distinguished authors, and I will talk about them in few seconds. And the program is what you see here in the slides. Now we will have the presentation of the report, which is approximately 45 minutes. And then we have 2 super distinguished discussants, which have read in advance the report. One is Jean-Charles Rocher, which we are all honored of having him here, even physically. He's actually the chairman of our scientific committee, and is literally one of the most senior person in finance, not only in Europe and probably around the world. So it's really a great honor. And also my friend, co-author, but senior policy economist is Giovanni Della Riccia, which is deputy director in the research department of the IMF. So we basically have discussant, super expert in these issues, and so it's a great honor. And then, as we do in the other years, it's we have, after a break, we have a more open discussion with policymakers and practitioners. And so we thank Daniela Russo for her help from the ECB. And basically we have these three speakers, which is Daniela, which will be chair and is here, with Jochen Metzger and Franco Passacantando, which had problem and is on his way now because his flight was cancelled. So that's the talk of today. So thanks for the students for being here. It is very important, beyond the fact that the topic is, of course, relevant for the future of young scholars, and not only. So it's informal, so question, typically we should have them at the end probably of the general discussion, after the discussion, but probably for clarity it's possible to ask questions. Now, the main speaker, so it's three authors, but Bruno Be, which is here next to me, he is today's professor of finance and economics at HEC Paris. He's a product of France, and he has an incredible CV in finance, but he's a product of France, but he has been traveling a lot. Sometimes French people do not want to travel much because they love their country so much, but Bruno has... He obtained his doctorate in France, but then he has been teaching and research around, basically across the ocean, and so Toulouse, Carnegie Mellon, Oxford, LSE, and his CV is amazing. He has published in all top economic journals. He's been even editor of the Review of Economic Studies, which is the main European journal in the top 5 journals. We have this obsession with top 5, and Review of Economic Studies is the European one. And he was also editor of Journal of Finance, and he's fellow of the Econometric Society, and he has been advisor to very important institutions, including the New York Stock Exchange, the ECB, and the Bank of England. Now, one of the beauty of this report, and we'll see, is that it is non-technical, but it's also interdisciplinary by nature, because the co-author of Bruno are actually computer scientists, and so Sara is here with us. Actually, she's Italian. She's now head of the Laboratory of Trustworthy Intelligence Distributed System and Blockchain Program Coordinator at CA List in Paris Clay University. She's Italian. She was in Rome in the past, and she had a PhD in computer science. So it's actually, I really thanks Bruno for putting a team, and the third co-author, which is not here, is also a computer scientist, Amos Huguenou, how do you pronounce? Yakole, okay, is the third and is not here with us, but he's also a computer scientist. So we have really this interdisciplinary approach to one issue, which is, of course, by itself super technical. So I think I spoke too much. I now give the floor to Bruno. And thanks for everybody for being with us.
Thank you so much. It's a great honor, and I'm very grateful and a bit shy. So thanks a lot. So this is, fortunately, it's joint work with competent people. So Sarah and Yakole, who taught me a lot of things about computer science, and it's really, as Pietro said, it's so nice to be able to combine the two. So, of course, I should try to make a reference to drop names, because this guy and me, we were actually alumni from the same school. I was reading a little biography on Wikipedia for Carlo Alberto, and he spent part of his life in France, and he was actually at the high school in Bourges, which is a very small city where I grew up, and I was in the same high school as him.
So, when I saw this,
so it's really a meeting of, old friends. And of course, another old friend is Garibaldi. It's quite important to have him in Italy, Yeah, red sweater, huh? Okay, so now we have to work, I'm sorry. So we were trying to look for an angle, for a way to approach the question that would make it a bit less boring. And we thought maybe the question of centralization and decentralization is an interesting way to approach the problem. So centralization is when you have a single or a few central authorities, and they're in power. They're in charge, and they decide, they run the show. You can think of the central bank, We can think of the state or its emanations. We can think of big intermediaries in finance. And so these institutions are very powerful. And the potential problem is that they might use their power to take advantage of the other people in the society and extract rents from them. So the notion of decentralization would be to, instead of concentrating the power in their hands, to disseminate the power and have more people have small bits of the power and collaborate to manage the system so that there will be less of a risk of a big group or big institution having power and extracting rents from the others. And I think this is maybe the idea behind blockchain. Blockchain is about decentralization, and I think it's about that. So what I will do today is tell you everything you always wanted to know about blockchain. That would be another one, more funny, but not me, and I'm not competent, and without daring to ask. So maybe we can think of four aspects of the problem. So the first aspect will be where we start, which is the decentralized ledger, the blockchain. So we're going to talk a little bit about that. What is it? How can it work? Once you have a decentralized ledger, you can think about a decentralized contract, which, as we will explain, is going to be computer code that is deployed on the blockchain, on the decentralized ledger. And now, once you have those two elements, you can go to decentralized money. How can you do that? Because, as I will tell you, within the decentralized ledger, we can create cryptocurrencies. We will have to define what it is. And even native cryptocurrencies, which are generated by the blockchain protocol itself. And we can also, using decentralized contracts, smart contracts, we can create tokens, and we're going to talk about that. And so once we have these two things, we have money and maybe other things. And those things, then we can trade them. And to trade them, then we can have decentralized finance or decentralized markets. So if you want, that's the agenda, that's the goal. And I will try to tell you a little bit about the technical tools and the economics of these four elements. And so, again, just to try to define this word decentralization, I'm using it a lot, but I'm not defining it very well. We're trying. So maybe here one way to think about all this as decentralized is that instead of being maintained by a central authority, it's maintained by a network of independent nodes who may not know each other. So that's the idea of decentralization. So this big program, how does it work and does it work? First, decentralized ledger. So an important moment in the history of those things was the white paper by Nakamoto. And in the abstract, you can read a purely peer-to-peer version of electronic cash, allowing online payments to be sent directly from one party to another without going through a financial institution. And then the main benefits are lost if a trusted third party is required. So the things I have put in blue here are the things which refer to decentralization. It's going to be maintained by peer-to-peer network. There will not be a financial institution, and there will not be a trusted third party. And so now we're going to try to see how this works. So the blockchain will be a decentralized ledger. So a ledger is basically a place where you put information. It could have been handwritten on a piece of paper and kept by a notary. Maybe like in Italy in the 16th century, they had ledgers. But here we have a digitalized ledger, and this ledger is decentralized. So what does that mean? It means that you have lots of different nodes in a network of nodes, and they're related by internet, and each one of them has a version of the ledger. So each node has the history, the data. And of course, we want all of them to have the same version of the ledger. That's really the trick. We want it to be decentralized, held by many people, they're independent, and yet they agree they have the same ledger. And so blockchain, what is the additional information when we say blockchain instead of decentralized ledger? Well, what we say is that we pronounce the word block. So that means that the data is organized in block. So if you want, in the first block, the genesis block, you have the initial state of the ledger. And then B1, the first block, is a bunch of changes to the ledger. So what is the information that we want to change, etc. Each block contains changes to the previous version of the ledger. And all these blocks are related to one another because each block is giving the reference to its parent block. And it says, I am the son of Bertrand. Okay. So, now how do you point to the parent block? You point, the name, the address of the parent block is going to be a string of data, a string of characters. And that string of characters is obtained with a hash function. So a hash function, so I'm speaking under the control of Sarah. When I say stupid things, you look at me and you say no. So you take data, you put it in a hash function, so that's the input. You put it in a hash function and it gives you a string of characters. So when you have a block, you take all the data in the block, you put it in the hash function, and you get a string of characters. So let's have Carlo, Alberto, and here you see that's the input, Carlo, Alberto, and that's the output, that's the string of characters. Now if you change very, very slightly the input, voila, you see, you change completely the output. So a very, very minor change in the input changes completely the output. So that's an important characteristic of hash functions. C'est un Mac, ça, j'arrive pas à utiliser ça, moi. Okay, so. Does it work? It's me. Usually when things don't work, it's me. So what we need, so now all the nodes have their own version of the network, but we need that all the versions are the same. So that means that when there is a change in the data in the ledger, this change has to be taken into account by all the versions. And in fact, they also have to be taken into account in the same order. So if there is a change because Pietro is selling a Bitcoin to Jean-Charles, and then there is another change in which Jean-Charles is selling the Bitcoin to Giovanni, these two events have to be recorded in the same order by all the nodes in the network. And now the question is, so this is an amazing amount of agreement, same information, ordered in the same way for all those networks that are independent, they don't know each other. How come they would reach the same conclusion? So this is the notion of protocol. The protocol in a blockchain is the sequence of actions that the nodes are suggested to take. So Nakamoto said, you should do this, 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 and that. That's the protocol. And if they do everything that Nakamoto said, then in the end, we have consensus. So, okay. But then something we really have to take out of our mind when we think about blockchain is we have to forget about having a central authority that gives the order to the nodes to do this, controls what they do, and punishes them when they don't. There is no central authority, there is no control. So what? Why are the nodes going to be doing what they are supposed to do? Well, it has to be that following the protocol is incentive compatible. And that's really one of the beauties of this field of study is that you need to think about a problem which, the computer scientists have invented this technology, and to understand it, you need to get information from the computer scientist. But at the same time, for the thing to work, you also have, it's human beings who are going to interact, and we need to have concepts from social sciences, in particular from economics. So that's, I think, the beauty of this thing. And so it has to be, the protocol will prevail and we will have consensus if following the protocol is incentive compatible. So incentive compatible basically means I prefer to do it than not do it. And so why do I prefer to do it than not do it? Because if I do it, I'm going to earn rewards, and if I don't do it, I'm going to suffer costs. So the rewards are going to be that in the protocol, it is specified that the person who collaborates to maintain the network, to maintain the distributed ledger, the decentralized ledger, and adds new information, that is, adds a new block to the blockchain. This person who adds a new block to the blockchain is going to get a reward. But again, it's not a central authority that gives a reward. Who gives the reward? It's the blockchain protocol, because in the blockchain protocol, it is written that if Giovanni adds a block, he's entitled to a reward. He writes this reward in the block, and all the members, all the nodes, we all agree that yes, Giovanni deserved the reward because he added the block. And so now, this reward has been created ex nihilo just by a line in the ledger. And this reward is paid in units of the cryptocurrency. So suddenly, in the ledger, we say, we have created additional units of the cryptocurrency, and those units have been allocated to Giovanni. So that's how money creation works in the blockchain. The punishment is basically, the reward is to give cryptocurrency to the person who does a good job. The punishment is to take cryptocurrencies away from the person who does not do a good job. So how does that work? In some protocols, if you want to add a block, to get there, you have to basically pledge some of your ownership of cryptocurrency. It's called stake. You have to stake some ETH, for example, ETH being the cryptocurrency of Ethereum. So you have to stake some of your cryptocurrency to be allowed to become someone who adds a block. And if it is found that I did something wrong when I added the block, I did not follow the rules, boom, they're going to take from me the cryptocurrencies I staked. So, 2 more slides on blockchain, and then we're done. So, now we have this network of all the people, lots of people could participate. And all of them, they want to become the person who is going to add a block, because if you're the person who adds the block, you get a reward. How are we going to choose who is going to be this lucky person? Of course, we don't want that it will be always the same person, because then we would have lost decentralization. We want the choice of persons goes from all over the network and everybody has a chance. So how are we going to do that? By drawing randomly the identity of the next person who adds a block. So it's a random draw. Now, the difficulty is to do this random draw without having a central authority. Again, we don't want to have a central authority. So it's not like, in France we have we have some lottery, I don't even know, la Loterie Nationale, and then some central authority is drawing balls. No, we can't do that here. So the blockchain technology offers ways to draw randomly in a decentralized manner. And there are 2 major ways of doing that. Proof of work, which is used in Bitcoin, and proof of stake, which is now used in Ethereum. And so proof of work is like in a sense, very stupid. You have to run your computer and burn a lot of electricity to solve a numerical problem. And there is no way to be smart about solving that problem. You have to use brute force. And when you find the solution, you show it to the others, and they can check that you did find the solution. So that's proof of work. And then proof of stake is smarter. You don't have to burn electricity. It's better for the planet. You stake some coins, and then using your stakes, there will be a protocol that will draw one of those who deposited stakes. So Ethereum in 2022 has moved to proof of stake. So now a third is doing proof of stake while the rest is doing proof of work. Okay, so last slide about blockchain. You need to have some guidance in the protocol. You need to give some guidance to the members of the network and tell them how they should react in certain situations. So in particular, there's a type of situation in which it's not clear what to do. It's when you have this blockchain, one block after another, and then at some point there is a fork. You now have two branches in the blockchain. Which of the two branches should you choose? So in the Nakamoto protocol, the suggestion is to use the branch which is basically the longest, with the largest number of blocks. Okay. So now, again, it's just a suggestion. There is no authority that forces you to do that. So what we want is that people prefer to do it than not do it. So what we want is that if I anticipate you guys are following the longest chain rule, it will be optimal for me to do like you and also follow the longest chain rule. So essentially what we want is that following the longest chain rule is a Nash equilibrium. Okay? And so, yes, it is a Nash equilibrium. We showed that in a paper with my friends and co-authors from Toulouse. But what we also showed in that paper is that this is a Nash equilibrium, but you have other Nash equilibria. So now we have a problem of multiplicity of equilibria. And why? Why do we have that? Because basically we have coordination problems. There are certain rules. If you guys are following this rule, I want to follow the same rule as you. So longest chain is one of those rules, but there are other rules which do the trick also. And so now we have a problem of selecting an equilibrium, which is very difficult, especially if we have a decentralized network of nodes. Then, so another environment in which it is also important to show that to study whether following the protocol is incentive compatible or not, is an environment that is similar in some respects to the environment we currently have on Ethereum. On Ethereum, the protocol, the way it works is you have committees. So you are selected randomly by the proof of stake algorithm to be a member of a committee. And when you're a member of a committee, you can vote for a block, to accept a block and add it to the blockchain or not. But not only do you have to vote, you have to coordinate with the others, and you have to check whether the block is valid. So the protocol specifies all the steps you have to take in this process. And the question is it optimal for the agents to follow the protocol? And so in our paper with Sarah and Yakole, we find that it is not. The protocol as it is described is not a Nash equilibrium. And basically it's because of problems of free riding. When you're part of a large group of people and you have to make a joint effort to generate a result, and this effort is costly, well, if you're not pivotal, it's very tempting not to do the effort and let the others do it. So it will not be incentive compatible to do the effort. So to restore incentive compatibility with the Sarah and Yakole, we propose a slightly modified protocol that makes people pivotal with some probability. And now when there is a probability that you're pivotal, now you think, maybe I should do my job, otherwise there might be a problem. So overall, at this stage, if I want to have a little intermediary conclusion, the thing is working. Decentralized ledgers are working quite well. Bitcoin is working quite well. Ethereum so far has been working very well. And so this is a major technological achievement, and not only technological, also it's a human interaction achievement. Now, what are we doing with that? Well, one thing we can do with that is decentralized contracts. So, smart contracts. So you write code, you put this code on the blockchain, it's going to be included in the block. And this code describes a sequence of actions. And it's the person who puts the code on the blockchain says, I pledge to do the actions that I have written in the code if you ask me to do them. Or if you satisfy the conditions that I put in my code for the execution of the code. So for example, it says, if Jean-Charles' plane back to France is delayed by more than 1 hour, then Pietro is going to pay 1 Bitcoin to Jean-Charles. So now, Pietro wants to do this with a smart contract. What Pietro has to do is to write the code, put it on the blockchain, but then, he's promising to pay. With what is he going to pay? So to make this promise credible, Pietro has to actually deposit in the blockchain the 1 Bitcoin that he has said he might want to give to Jean-Charles if Jean-Charles' plane is delayed. So that's how smart contracts work. Smart contracts are also used to generate tokens. And tokens are something very important because at least one part of the token is the digital representation on blockchain of assets, securities from the real world. So if you want to trade bonds in decentralized finance, you need to tokenize the bonds and have their ownership registered on blockchain. And that's a function that smart contracts will participate in. So, conclusion on smart contracts. Conclusion on smart contracts. Smart contracts and decentralization. Smart contracts is a technology that has been used, so far has worked very well. And it's really a form of decentralization because it enables you to do commitment, to have rules, without having a central authority, without having a trusted third party, without having a financial intermediary. So that's quite impressive. But as I will tell you, not everything is rosy in this world, and I will tell you about some problems. Third element now, decentralized money. We have decentralized ledger, we have decentralized contract, now we go to decentralized money. So first we take a little detour and we ask ourselves, what is money? So money, the modern technology of money is something that has been invented around here, or maybe in the north of Italy. So you guys are specialists in that, maybe in the 14th century or 13th century. So, but in more modern forms, more modern incarnation, fiat money is something that is nothing. It is something that is valuable but has no intrinsic value. Since 1971, nobody can go to the Fed in the US and say, here is my dollar, give me gold. There is no gold. There is no longer any collateral for money. So money is just something that is valuable because we think it's going to be valuable to the others. And why would such a thing, such a crazy thing, such a bubble be valuable? Because in fact, economic theory has shown that when the market is imperfect and incomplete, having the ability to use that bubble is actually helping economic agents to realize gains from trade, mutually beneficial gains from trade, that they could not realize without the money. So, maybe the first incarnation of this was in Vixel. It's a very beautiful Vixel triangle. I don't know if you have read that. It's 2 or 3 pages in the book, and it's absolutely lovely. There is no equation, but it's a model in a sense. It's a conceptual simplification of the world to try to make a theoretical point. So basically what Vixel and then Kiyotaki and Wright later did was to say, okay, if we are in a world in which we have such frictions and we have also limits to commitment, this bubble money can help us realize gains from trade we could not realize without it. Another approach is to think of markets that are incomplete in the sense that we cannot get together, all together, and exchange contingent goods depending on the state and the time. A complete market will be, we all get together at time zero, and then we can trade all the contingent goods for the future at all times. But if we cannot do that, can we still do something that is going to help us share value? Well, Samuelson, and then other guys after him, showed that yes, it was the case with money. So here, it's a little parenthesis, because what I'm telling you now is not something that has been theorized about cryptocurrencies, about Bitcoin. Huh? This is a theory of the dollar. This is a theory of the euro. So some people say Bitcoin is a bubble, and they're right. Like Jean, our colleague Jean Tirole says Bitcoin is a bubble. As always, Jean is always right. So it is a bubble. But as always, there is something more to what he says than you think you understand. If you think you understand, you haven't been thinking long enough. So it's not only a bubble, it's a rational bubble, and dollar is also a rational bubble. So what's the difference? What's the difference between the centralized bubble, dollar, and the decentralized bubble, Bitcoin? Well, the centralized bubble is centralized. It's managed by the central bank, the banks. These are large institutions. The power is in their hands. Cryptocurrencies, there's no bank, no central bank, no large institution. It's decentralized. Yet, some people using the framework of Samuelson and papers that came after, for example, Neil Wallace. Neil Wallace is a great guy. He's a great monetary theorist. And when he saw Bitcoin, he understood very quickly that, in fact, the kind of arguments you apply to the dollar, you can apply them also to Bitcoin. So cryptocurrencies can serve the same kind play the same kind of role as centralized money in terms of making markets more complete, helping agents to implement mutually beneficial gains from trade. That being said, in these models of bubbles, in general, you have multiple equilibria. So you have an equilibrium in which everything goes well, and the bubble is very useful, and we capture gains from trade. And then there's another equilibrium in which, at some point, maybe a sunspot, boom, the equilibrium is such that the value of the bubble goes to zero. And it doesn't need to be anything exogenous. The value of the bubble goes to zero because we all think the value of the bubble should go to zero, and therefore it goes to zero. So there is equilibria like that for the dollar. There is equilibria like that for the Bitcoin. But of course, in the case of the dollar, you have the state, you have the Fed, you have the banking system. And so all those centralized authorities, which in some sense we don't like, also in other sense maybe we like them because maybe they help us coordinate, they help us prevent the occurrence of this bad equilibrium. For Bitcoin, we don't have it. So frankly, I'm a great fan of blockchain, and I've been working on it for 10 years, but I've always been convinced that there is a probability that the value will just vanish. Maybe the probability is not too high, I don't know. So, in practice, this is M1 in the US. This is M1 in Europe, and this is the capitalization of Bitcoin. So it's about 10% of the capitalization of M1 in the US. So really, Bitcoin now has become a big thing. It's important. If we compare dollar and Bitcoin, it's not completely different orders of magnitude. Now, another thing, monetary policy. So at the time at which Bitcoin was created, we were in a great financial crisis, and some people were really upset about the fact that central banks were injecting money into banks, while, frankly, the crisis was in part due to the behavior of the banks. So this notion that sometimes the central bank cannot helping the bad guys is something the proponents of Bitcoin really disliked. And it was written, in the first block in the Bitcoin blockchain, there was a sentence on that. So to try to avoid that with Bitcoin, with cryptocurrencies, you have a predetermined monetary creation rule. And that monetary creation rule is written in the protocol. You remember the protocol we discussed? We said when Giovanni is adding a block, he gets so many new Bitcoins. That's how money is created in Bitcoin. And this is part of the protocol. So the protocol, and if everybody follows the protocol, then everybody's going to do that. And then we are all committed to this monetary policy. And so far it has worked amazingly well. So this is the number of new Bitcoins created. So that was the creation of Bitcoin. Then the protocol said after a certain number of years, you go down, and you go down, and you go down. And it was actually applied exactly. So the monetary policy of Bitcoin is determined by the protocol. It is followed by the agent because the protocol is incentive compatible, and it results in a reduction in the rate of growth of the Bitcoin money supply. All right, so now we have money, we have centralized money, we have decentralized money. Decentralized money is not as big as centralized money, but it's still big. Now, why do we care? So Giovanni yesterday teased me and said, yeah, you've been working on Bitcoin for 10 years, but frankly, that's a waste of everybody's time because it's, can you tell me if in any sense this can be useful? So I think here is the first reason maybe why it's useful. If you live in Italy, Italy is known for its great monetary policy, very committed and reliable and trustworthy. So, because of the Germans. But so then we have basically no doubts about the euro and the monetary policy. So maybe we don't need Bitcoin. But if you live in Nigeria and the value of the naira is going down like crazy, or you live in Lebanon, or you live in Turkey, you live in one of those countries in which the central bank policy, I didn't say the US, the central bank policy is not independent. And you have a problem with the official currency now. And so maybe you want to hold something else. Maybe you want to hold another currency which is not subject to this risk of hyperinflation and excessive creation of money. And now that could be the role of cryptocurrencies. So we have a paper with Stéphane and Jean-Charles about this, and we are not really exactly empiricists, but there's a graph in the paper so we have 56 countries. We rank them by quartile of cryptocurrency adoption. So these are the countries which have the smallest amount of cryptocurrency adoption. These are the countries with the largest amount of cryptocurrency adoption. And then we compute the average inflation for each of the quartiles. And so you can see that countries in which cryptocurrencies are adopted a lot are also countries in which there's a lot of inflation. So now, let's go to a topic that is dear to the heart of a benevolent central authority ruling a big country on the other side of the Atlantic. So stablecoins. So stablecoins, what are they? Can they be useful? So they are not exactly the same as Bitcoin and Ethereum. They are, you remember, we talked about tokens. They are tokens. Tokens, that is, digital representation of something that is elsewhere, and that digital representation is created by a smart contract. So the two biggest crypto stable coins are Tether and Circle. So here is the balance sheet, maybe let's say of Tether. They sell you one stable coin, you give them $1 and a few cents of fee, and this $1, they're supposed to hold it in very, very safe and liquid reserves. So that your token, the value and the liquidity of your token is about the same as the value and liquidity of the reserves. So now you have the good sides of both worlds. You have the token is registered on blockchain, so you have all the wonderful benefits of the blockchain technology, but it's backed by the reserves, so it's very stable. So capitalization of stable coins is quite high. Tether, Circle. So this one is special because those guys, their reserves are off-chain. So really they're a bit like narrow banks. You know, you have a deposit, they invest it in T-bills. You can use your deposit as a means of payment. This guy is very different, DAI, it's relatively small compared to those guys. But this is different because this one is only on blockchain. So the reserves themselves are assets which are on blockchain. So now you give them a certain number of Bitcoin, they give you a stable coin. What you gave them, they're going to hold it as reserves. But you gave them a Bitcoin. It's risky. How can a risky thing be a collateral for a safe thing? The answer is simple. Over-collateralization. So you have to over-collateralize. That's costly. So basically we have a trade-off. Tether, no over-collateralization, but you need to trust a central authority. DAI, decentralized, but you need over-collateralization. So, okay, should we trust Tether? So this is the structure of the reserves. So you see the vast majority, around 65%, that's treasury bills. Then, they have Bitcoin. And they have precious metals. And a lot of other things. So you see, some of their assets are actually quite risky. Plus, a lot of their assets are liquid if you want to trade a small amount. But if you had a run on Tether, and Tether had to sell its reserve quickly to redeem the stable coins that people are asking for, I'm not sure the liquidity of the treasury bill market would be enough. So that's a bit of a problem. Now, why are they doing this? Well, one of the reasons is because they make money. You know, they earn the interest rate on the treasury bills. They earn the expected rate of return on risky assets. So they make money by taking risk. If the risk materializes, who's going to pay? The depositors? Or is the Fed going to help them? We don't know. So now, another thing about stable coins. For the moment, stable coins are just part of the cryptosphere. They are used by people who trade cryptocurrencies and want to park their gains. Okay, so now, last bit, decentralized finance. So basically, one way to define decentralized finance is something in which you are using smart contracts to automatically execute transactions in a decentralized manner on blockchain. And so here you have the number of applications of DeFi for different things. So you have lending and borrowing, tokenization of real-world assets, decentralized exchanges, etc., stable coin issuance, etc., etc. So all these activities are, in many of them are activities which used to be performed by financial intermediaries, by banks, by brokers. And now, maybe with the decentralized finance paradigm, they could be done by smart contract in a decentralized manner on blockchain. So why on earth would we like to do that? So I think it's two things. First, maybe the intermediaries are earning rents, and we want to compete the rents away from them. Second, maybe the intermediaries are using antiquated technologies, but it's very hard for them to move to more modern technology because there are vested interests inside a big organization. Some people who know how to use the old technology, some people who have stakes in the old technology. Very hard to move away from that. So maybe in those environments, you need to have Schumpeterian growth. You need to have new innovations that come in and destroy the old values, the old technology, and they create new value. So maybe decentralized finance is a Schumpeterian innovation. So for example, something you could do maybe with decentralized finance is you want to trade securities, bonds, maybe even stocks, or maybe real estate. You tokenize them. Now they have a digital representation which is registered on blockchain, and you organize trades which are automatically executed on blockchain by smart contracts. One of the advantages of that is once you do the trade, so let's say Sarah has a beautiful house, but I have a lot of bitcoins. I want to buy Sarah's house. It has been tokenized. I buy it with my bitcoins. We don't need to go to real estate agent, wherever. We do this on blockchain, and we send the transaction. We sign it with our private keys. We send it to blockchain. It is executed when it is incorporated in the next block. How long do we have to wait for a block? 12 seconds. When the block is, when our transaction is in the block, that's it, it's finalized. Or maybe we wait a few more minutes. And then there is atomic settlement. So the transfer of the house ownership and the transfer of the Bitcoin ownership are done in the same transaction. So, all the settlement risk associated with non-simultaneous, lengthy settlement disappears. That's quite nice. But you will see it's not as nice as we think. So, first, we talk a lot about decentralization, but when it comes to trading cryptocurrencies, where are they traded? Most of the time, transactions in cryptocurrencies are done in centralized exchanges, which are institutions off-chain with all the problems of risk-taking and agency problems associated with that. FTX, for example, was a centralized exchange. And talking about decentralization, Binance, you see that this big chunk? More than a third. And then if you add these guys, like 7 exchanges are doing more than 3/4 of the transaction volume in cryptocurrencies. And these institutions are not decentralized. So you remember the motivation initially was we want to get rid of the monopoly power or the oligopoly market power of the big guys, and we want to decentralize. And if you want to compare those big centralized guys and decentralized exchanges, I will tell you about decentralization in a minute. These are the counterpart in the completely on-chain world, with only smart contracts and automatic execution. That's transaction volume in Binance, weekly transaction volume. This one at the bottom, that's transaction volume in the most active decentralized exchange, Uniswap. So you see, these big guys are really the big guys. The decentralized guys are very small. So that's, a grain of salt when we talk about decentralization. Now, how do these, so now these small guys that we have here, I'm telling you, oh, it's great they're decentralized. Wait a minute. Is it? So, the way they work is, you remember, smart contract is code you put on the blockchain and Bitcoin or Ethereum, ETH, that you deposit as collateral. So, the majority of these decentralized exchanges, they use something called the constant product pricing function. So I am Alice. I want to supply liquidity. I deposit 100 ETH and 400,000 DAI. DAI is a stable coin. One DAI is $1. It's entirely decentralized. So now that gives us an exchange rate of 4,000. I chose the numbers to be not too far from reality. Now, when she starts, if you multiply 100 by 400,000, that's a number. When Bob comes and he wants to buy one ETH. So now we start from 100. The new number of ETH in the AMM will be 99. And he has to give Q dollars, And where Q is set such that this product is equal to that product. That's why they call it constant product. And that's around 4,040 die. That's the first ETH you buy. Applying the same formula, after you bought the first one, you want to buy a second one. Now you need to pay 4,081 dies. So you see, the price, the unit price increases if you buy more and more and more. But of course, if you sell, if somebody comes and sells, it pushes the price down backward. So, well, that's not very interesting. So now, first problem. I think it was identified by a guy called Andreas Park, who's a very good guy. He's an economist at Toronto. Not Torino, Toronto. Sounds a bit similar. So, what can you do? So, did I give names here? Yeah, I gave names. Bob, let's say Bob is a good guy. Bob wants to buy 1 ETH in the decentralized exchange. Bob sends a message, everything is happening on blockchain. So if I want to do something on blockchain, I send a message to the network of nodes. You remember this decentralized network of nodes. And before it gets executed, it's in some space called the mempool, memory pool. All right. And now what should happen is that someone sees the message, puts the message in his or her block, so that the transaction is executed. But there's this nasty guy, Chris, who's monitoring the mempool and sees that Bob has done that. Then Chris says, okay, I'm going to send a message to buy 1 ETH. I'm going to buy it at 4,040. Then I will let Bob buy his at 481, and then I will sell back what I bought at this higher price. So basically what I do, what Chris is doing here, is making money by front-running Bob, taking advantage of his knowledge of how the price increases in the computer code. And how come Bob is going to be able, Chris is going to be able to do that? Because Chris goes to the validators, the network of nodes who put the transactions in the blocks in the blockchain, and basically strikes a deal. Say, I'm paying you this transaction fee in exchange for you to do this for me. So you let me front run, I give you a fee. So you see, we were starting from the fact that we hoped that by decentralizing things, we would get rid of agency problems, we would get rid of rent extraction. Here we see a big way in which it doesn't work. And it's funny because sometimes, the computer scientists, they are very honest and candid. And so they call this maximum extractable value. So it's really about extracting rent. And now it's even worse than that. Because now this has become really systematized. And you have guys who use artificial intelligence or whatever to identify a lot of front-running trades. They come up with a block with a certain ranking of the transactions that let them front-run the others. And they go to the proposer, who is the guy who is actually going to add the block to the blockchain, and they say, I give you a fee in exchange for that, you put my block on the blockchain, and I earn all these front-running profits. So that it's been systematized. This system, decentralized finance, we thought we got rid of intermediaries, and now competition was giving us an optimal, competitive regime. No luck. And it's not like these guys are small. Huh? These are the builders. This is the market share. What fraction of transactions in blockchains come from those guys? You have this huge guy called Builder. More than half of the trades in blockchain on the ETH blockchain comes from him. The second guy, BuildNet, another huge chunk. So you have these huge animals there whose business is to extract rent from final investors. So we wanted to have decentralization, to get rid of rents, and I'm actually done. 2 more slides. So we can conclude now with the last 2 slides. the question we started from was, can blockchain decentralize ledgers, contracts, and markets? And then, if you want, the subtitle was, but why on earth would we want to decentralize? And the idea was, we want to decentralize because we want to avoid rent extraction by central authorities. And I think the answer is, yes, blockchain has been able to achieve some amount of decentralization. But it's not true we have been able to eliminate all the rents by doing that. Some clever intermediaries kicked in. They used the faults of the system to create new ways of extracting rents. So if you ask me, what are the things that work well and the things that work less well, I would say decentralized ledgers, it's an amazing success. Bitcoin, Ethereum, the decentralized ledgers have been operating faultlessly. Validators, the nodes in the network have been following the protocol. Everything has gone according to plan. It's an amazing success. Now, so that is great. Now, what do we do with it? And the way we use it, I think we still have problems. We still have problems, and I think we have two types of problems. One is, you have the emergence of those new intermediaries who are actually taking advantage of the system to extract rents. And we have the second type of problem, which is, and it's related to Giovanni's question yesterday, why on earth would you do that? Is it going to be useful to? Is we really need to find a way to link the blockchain world to the off-chain world, to the real world. So I was telling you about this wonderful tokenization, that's great. But tokenization is taking assets from the real world and putting them on the blockchain. This is not obvious. How to do that is not obvious at all. I didn't tell much about it during the presentation for lack of time, but there's a lot of legal problem. The fact that you have ownership of a bond on the blockchain, does that imply that a court in the real world that is off-chain will give you this property right, will grant you this property right? We don't know yet. And that also shows that maybe having things on blockchain is not going to be able to let us completely avoid the off-chain world. So I believe that an important aspect of what's going to happen in the future will be the construction of this interaction between the off-chain world and the on-chain world. And then the last slide is to offer you a little bit more of the bubbly. It's a bubble. We don't know. It might burst. AI, some people say it's a bubble. I don't know. It's only once they've burst that we know they are bubbles. Except for Bitcoin. Bitcoin, we know before it bursts that it's a bubble. And so if the AI bubble was a bubble and did burst, could that be the trigger? That could be the sunspot that could generate a sharp drop in the value of Bitcoin? Frankly, I can't tell you. Merci.
Thanks, Bruno. Very nice presentation. So I think we wait for questions to the general discussion. So we give the floor to discussion first. Jean-Charles.
Thank you very much for giving me the opportunity to discuss this report. I learned a lot about the blockchain, and I really congratulate the authors for what they do. In particular, they summarize the technological development brought by the blockchain innovation in payments and finance, and for me that was really useful. And then they try to do more. They try to study whether these developments will allow the quote-unquote decentralization, and I will come back to the meaning of this word decentralization of money, contracts, and markets. And also, it analyzes the main challenges and opportunities in the crypto sphere. And to summarize the most important milestones that are well explained in the report, first, it all started with the Bitcoin in 2009, and it's not a coincidence that it was just after the global financial crisis. And so Bitcoin, and I quote the description made in the report, it's a purely peer-to-peer version of electronic cash, allowing online payment to be sent directly from one party to the other. And the most important part is the last few words, without going through a financial institution. And I come back to that. Then in 2015, there were the innovation of smart contracts, which are digital contracts that are automatically executed when predetermined terms and conditions are met. And finally, the more recent milestone of 2018 of automated market makers, which are decentralized exchanges that use algorithmic mechanisms to facilitate the trading of digital assets. So first question, why on earth do you want to decentralize money, right? Why? And Nakamoto wanted electronic payment services that did not rely on financial institutions. And in fact, it's a complete alternative to the existing so-called two-tier payment system that has been elaborated through ages by the central banks, politicians, and commercial banks. And this idea that our system, our payment system, works in two levels, where the central banks manage the payments of commercial banks, and the commercial banks manage the payments of non-financial institutions, and everybody else, you and I, and the central banks regulate the creation of private money by the banks. So a large fraction of our money is private. It's commercial money, it's the bank deposit. But the central banks, they have a say on the quantity of money that is created through credit. And this is not very different from the criticism of Nakamoto that he didn't trust financial institutions. So, in fact, it's related to the famous critique by Friedrich Hayek, who wanted to abolish central bank's monopoly of issuing currency because he observed the disaster generated by hyperinflation in Austria, Hungary, and other countries. And hyperinflation still exists, as Bruno indicated, in Venezuela, in Zimbabwe, in Lebanon, etc. But in fact, Nakamoto wants more. He wants to abolish central bank control over issuance of public and private money. So Nakamoto is not so much against the government, it's against financial institutions. And in fact, what struck me during Bruno's presentation is that the whole history of banking had been a sort of collusion between the politicians and the bankers. If you go back to Croesus, or maybe the Medici, or maybe Napoleon, or the modern dictators, you realize that from the start there was a collusion between the bankers and the rulers, the politicians. And when a dictator wants to hold control of a country, the first thing he does is control the banks as well. And so maybe the blockchain is a true revolution. It's the first time in history where people try to organize the financial sector without having to go through this network of old boys, people who know each other from high school, and some are politicians, some are bankers. They work together well. And of course, the young generation is fed up with that, and that's why they support the Bitcoin. It's not only a question of technology, it's a question of the old world. And it's also not a surprise that central bankers oppose the blockchain because they want to keep their position. So maybe we are living through a true revolution. But maybe I'm too enthusiastic about that because, as I will try to argue, it doesn't work so well. The first thing Nakamoto wanted to do is to discipline banks and eliminate inefficiencies and rent extraction. And I think there are two massive inefficiencies that are really obvious to everyone. One is the security settlement, the fact that it's lengthy and costly, and that the banks actually use these inefficiencies to make money through security lending. And the other inefficiency, the biggest market in the world, the market for foreign exchange, is the most inefficient market in the world due to the system, outdated system of correspondent banking and brokers. And so this clearly doesn't work so well. And maybe that's a motivation for getting rid of this old system. But the question is, what will we get with the new system? Are you going to do any better than that? And in particular, who wants a distributed ledger? For me, it's a very strange notion. You know, a ledger for me is something centralized almost by definition. In each jurisdiction, there is a centralized land registry, for example, where the ownership of houses and land is recorded. And this is totally centralized, except that changes in ownership are recorded by intermediaries. In other words, individuals do not really have access to this centralized land registry. They have to go through intermediaries. And in fact, it's very similar to the two-tier payment system. The two-tier payment system is a system where on the top you have the central bank that controls everything, but the access of individuals to these ledgers is done through intermediaries, okay? And the same is true for securities. If you look at the central security depositories like Euroclear, Clearstream, DTC, they are in very small number. And there is a natural monopoly in this centralization. But the problem is that we need intermediaries to access to these systems. And so can the blockchain remove these rents extracted by these intermediaries without breaking scope economies? And in fact, it's a real topic for research. Some of you want to do research on crypto economics. I think this notion of who is going to monitor or certify transaction, we want to have a system where a few intermediaries do the certification but extract rents, as opposed to a system where basically everybody is able to monitor and certify, which is more costly, but there is less risk of rent extraction. Automated contracts is also a very interesting line of research, because financial contracts are often incomplete and difficult to enforce. For example, bankruptcy procedures are often very lengthy and very costly. And smart contracts can ensure automated enforcement. It's the notion of atomic settlement. So you realize the gains that can be obtained if such a system is generalized, if you have instantaneous settlement of security transactions. But the problem is that there are limits to what automated contracts can do. And these limits are related to the so-called oracle problem. If you want to automatically execute a contract, this contract must only depend on information that can be put on the blockchain. And this information is limited. So there is a really effort to be made on the optimizing the structure and scope of contracts that can be automatically executed. And finally, something which also looks very strange, why do you want on Earth to decentralize markets, right? Because I learned, since I started doing finance, I learned that it's best to have a single market where everybody observes the prices. There is only one price for one good, and everybody is able to observe this price, and there is, the price discovery, where the information of individual traders is aggregated through the market mechanism. It's a fantastic instrument for aggregating the information of individuals. But this requires a single exchange and a transparency of the trading process. Now, if you have a single exchange and probably an oligopoly of intermediaries that allow access to decentralized exchange, they are going to extract rents, right? So public authorities have decided to say, oh, this is bad. We don't want to have oligopolies. We want to encourage competition between exchanges. And for me, it's going against the doctrine of price discovery. So automated market makers, they even go further by sort of reinventing the law of supply and demand, and this constant function scheme is really very strange for economists, because it seems to presume that the price relation between two goods or monies or currencies is something fixed, and it doesn't depend on the economic conditions. And so there is literature on the regulation of infrastructure services. You know that the problem of infrastructure is not new for airports, for roads, for networks, etc. It's clear that you don't want to have a proliferation of infrastructures that would duplicate the costs associated to the provision of services. But on the other hand, you want to allow access to this infrastructure in a fair way. So maybe there are lessons to be drawn from this literature in the domain of decentralized markets. And finally, I would like to conclude by saying that I recommend reading this report for anyone, especially PhD students who want to specialize on crypto economics, because it's a very useful analysis both on the technological aspects and the economic consequences of these technological aspects. And it underlies the political economy, the ideological aspects of the current debate on the cryptosphere. So I congratulate the author for their report. Thank you.
Thanks, Jean-Charles. So I also learned the comparison between the land registry and the banking system, the central bank, so which is quite inspiring. So that's why notaries are as hated as banks in Italy, probably. Anyway, so the second discussion is Giovanni from the IMF. Again, 10-15 minutes, please.
Yeah. Well, thank you, Pietro. Thank you for the invitation. And, the disclaimer is here on the screen. Whatever I say is my own views. Do not ascribe them to the fund. We had the same acronym as Tom Cruise's movie. Different meaning, but they will deny any knowledge of my existence if you attribute my views to them. So let me start by saying this is an incredibly crystal clear and accessible description of what I call the plumbing behind blockchain and crypto in general. I learned a lot. Frankly, I knew the economics of it, but I really did not know the nitty-gritty behind the economics. And I think this is not to diminish the nitty-gritty. The nitty-gritty is really important here. It defines incentives, it defines where the failures are and where the successes are. So it's very important. And there is also a very effective discussion of the potential benefits and challenges of the decentralizations of money, organizations, markets. I think Bruno did a fantastic job in his presentation, so I don't want to spend much on that. I'm going to sort of take a deviation, if you want, and think a little bit about the economic application of cryptocurrency in general, a little bit more in particular of stable coins. I'll cover 4 points that, in my view, are separate but very interconnected. One is public versus private money and sort of a privatization of monetary policy. The second one is a trade-off that Bruno didn't really cover between privacy and safety, and I'll explain what I mean with that, and how this led to the emergence of intermediaries and centralized exchanges, both in the past and now. Third, as I said, I'm going to talk a little bit about stablecoins and their role as narrow banks and how they may impact the landscape of financial intermediation as we know it today. And finally, I'll talk a little bit about the cross-border benefits of crypto. So let me start. I must have missed one slide. Okay, there you go. So is crypto good or bad? Well, I think it depends on whom you ask. So if you ask a resident of a country with draconian financial repression and poorly run monetary policy, they'll say crypto is fantastic. At least as an individual, you'll find it very beneficial to be able to invest in something that is not the currency of your country. If you ask a policymaker that is trying to control capital flows for potentially good reasons, they'll say this is the worst thing. It sits next to the devil. It makes it almost impossible to control capital flows. It makes it very hard to do anti-money laundering activities of any sort. So here I'm plotting, this is based on a working paper of some my colleagues from a couple of years ago, and it's based on a survey in terms of adoption. And you see that some of the things that Bruno talked about are there. So countries that have higher inflation regimes, this is an average over 10 years, from 2011 to 2020, have clearly, there is a clearly positive coefficient there. Financial development goes the opposite way. So if you live in a country with a lot of opportunities to invest, you tend to adopt less crypto. But it's also countries with less corruption enforcement that have more crypto. Countries with more informality have more crypto. So this goes a little bit to the criminal side of the attractiveness for agents that live on the side, the edges of legitimate economic activity to use crypto. And financial repression, this is on capital control. So when you have a lot of capital controls, you tend to have more adoption. So let me go now to private money and monetary policy. So if you look at the way the protocol of Bitcoin is designed, it reminds a little bit of money targets. So you go back to Bundesbank, 1960s. And indeed, there is to some extent, is a very efficient way to keep prices stable. But it has some, by now, monetary theory has evolved, and we know that with a fixed money supply, you're going to have very unstable interest rates because you have money demand that is not stable, and the interest rate will spike or crash depending on that, and the central bank will have no way to control that. And indeed, to some extent, what we see in the volatility of value of Bitcoin is, to some extent, a result of that. I would add that if you have strict money targets that you never change, because this is stricter than money targets, because money targets every year you could change it. You say, okay, this year's 10%, next year's 5%, depending on the cycle. With the algorithmic monetary policy, you have no way to use discretion, which means you cannot use monetary policy for cyclical stabilization, which means that the entire cyclical stabilization goes on fiscal. And fiscal is slow, is sluggish, there are a lot of lags, you have to go to Congress, it's not an effective cyclical stabilization tool. So could you imagine a more complicated algorithm where instead of saying a fixed money supply, you have, say, a Taylor rule? But in order to do that through a Taylor rule, you are going to need oracles, as Jean-Charles was pointing to. So you're going to have to trust somebody that tells you what our star is, where is income, where is inflation, and put it into the system. And then the system is going to spit out a number, say an interest rate or a money growth rate. So this goes back to a centralized, somebody is going to be centralized. It's going to be the statistical office, it's going to be somebody like that. And it's also open to data manipulation. If the markets know exactly what the function is that spits out monetary policy, you have no creative ambiguity, to use some of the ECB language, and this is a problem in terms of markets speculating and anticipating the moves of the central bank. And finally, I would like to say, even if we could do it, would we want to do it? And I would argue that if you go pre-global financial crisis, there was a clear trend in monetary policy theory and in central banks to see central banks as super sophisticated computers that would take all this data and spit out a number, the interest rate. And we had the ESG models that wonderfully said that this was the best possible world. There was the divine coincidence where by keeping inflation low, you also kept the output gap low, and everything was beautiful. And then we learned post-GFC that below this tranquil surface of macroeconomic variables, monsters were growing. And when monsters grow, then monetary policy becomes more art than science. You don't have anymore just the price level or the inflation level to control, but you have, for example, things like leverage, credit booms, all sorts of things, risk-taking by financial intermediaries. And that gives you multiple targets, but also multiple policy dimensions. Think about forward guidance, think about macro-pru, a number of things that we have started to use and learn how to use that are important and it's very difficult to think that we could delegate to a computer. So let me get now to the safety versus privacy. So cash is anonymous. Many cryptocurrencies are anonymous. So cash has a problem. It can be stolen, it can be burned. You know, if you lose a credit card, all you need to do is to go on your computer and block the credit card. It's no sweat. If you lose $200, you lost $200. Nobody's going to give them back to you. Crypto at the moment is very much like the $200. And so because of that, in the past, in this country in particular, banks emerged where you would give them your money and there would be a ledger with your name, enforceable under the law. And so you couldn't lose the money anymore. There was a link between your physical persona and this wealth. And of course, these intermediaries had agency problems. They had moral hazard. They would use the money in excessively risky ways. Sometimes they would go bankrupt. Sometimes they would just steal the money. And so modern supervision and regulation and public guarantees have added a layer of insurance and have tried to correct these private incentives to improve the functioning of the system. So now you look at cryptocurrencies that have similar risk, and indeed, there are plenty of episodes where people have lost their Bitcoins in the order of millions of dollars, and they have no recourse, essentially. And so you have these centralized exchanges like FTX, where you would essentially deposit the Bitcoins. But then you have, as we have seen with FTX, you have exactly the same sort of agency problems that we have had with banks without the layer of insurance and supervision that is provided to the official banking, traditional banking system. So it's likely that slowly the system will evolve in that direction where you will have more and more government intervention into this market and into these intermediaries if you want to make them work. But then all the benefits of the decentralization, we risk to throw the baby out with the water. Finally, I would say there is clearly a trade-off between privacy and anti-money laundering effectiveness. One potential role for central bank digital currency is exactly that. So I know that the ECB is experimenting with this, and one of the designs says, okay, expenses would be anonymous up to a certain level, but not beyond that. So you protect privacy for the small purchases, but not beyond that. So third point is stablecoins as narrow banks. So as Bruno pointed out, think about the narrow banks in the west of the United States. In the 1800s, this is Wild Wild West. People would deposit gold coins or silver coins in a bank, and the bank in change would give you pieces of paper. And there were, to some extent, limited supervision and some regulation forcing these banks to keep the coins into reputable investment like treasury bills. It was the Wild Wild West. They very rarely work well, and all the agency problems that you can imagine emerging from this, like they would print more banknotes than they had the reserves. And the stablecoin is very similar. So let's think for a second about what are the synergies between the payment system and the credit system that we see today. So the main synergy is that the liability of a commercial bank or a deposit-taking institution are accepted as a form of payment. So when you go and ask for a loan to a bank, they don't need to have the money. They just need to have credit and credibility. All they do is to open a deposit in your name, and that's your loan. So they have created private money out of thin air. The reason that they can do that is that deposits are accepted. You can use them and spend them, and are accepted as a means of payment. A mutual fund can do credit exactly like a bank, but on the liability side, they're going to have to issue some kind of commercial paper, so they have to pre-fund themselves in order to give you a loan. So this liquidity creation at the margin is a critical element of the system. Frankly, I've been thinking for many years about how to measure the importance of this particular function empirically. And it's, trust me, at least if somebody has brilliant ideas, let me know, because it's not obvious. So in all our beautiful banking models, theory banking models, we don't do this. Banks are sort of manufacturing companies that take deposits and make loans. And they typically are static models, and you don't have this margin effect. So imagine a world where stablecoins take over the payment system, and where banks are not banks anymore, but they are mutual funds that issue credit. So in that world, you have complete separation between the two things, and you lose this marginal creation of liquidity, which I said I don't know how important it is. But there are other challenges. So first, there is an immediate reallocation of savings from risky assets to risk-free assets, so treasuries. So all the payment system that now is provided by banks and deposits would be with stable coins that are mandated to invest only in central bank reserves or short-term T-bills, which means you have a subtraction of resources from the real productive sector, or at least an increase in the cost for that sector. The second point is that would these new narrow banks stay narrow, or would they fall into the same traps, if you want, and in the same mistakes as the narrow banks of the American West? And we are writing a little model on this, a very really Mickey Mouse model, and you see that the temptation to deviate from the risk-free portfolio will increase with the dominance of the stablecoin. And the reason is that the more they become dominant, the more the banking system shrinks, and so the more profitable opportunity there will be to issue risky loans, which in turn means that the supervision and regulation will have to become more and more intrusive as the stablecoins become more dominant. And again, there is a little bit of a problem with that, and thinking about a decentralized system with a very intrusive centralized regulator. And finally, and this is the episode of Libra, for those of you know, when Facebook tried to issue a stable coin, is that if people start invoicing contracts and prices in the stable coin rather than the underlying fiat currency, there is a risk that at some point this thing becomes so dominant that it pulls a Nixon move. And so if Zuckerberg at some point, imagine Libra has 2 billion, if Libra had succeeded and had 2 billion users that start invoicing contracts in Libras, at some point they would say, you know what, we are not following the basket anymore, we are just printing. And now you have a fiat money issued by a private entity, which not necessarily follows what a benevolent central bank would do. So these are all questions that go back a little bit to the interaction between private and public money. Now, finally, in the last 2 minutes, I want to talk a little bit about one, because I struggle a little bit to think, to some extent, as a policymaker. If you ask me, I don't like crypto. And so far, as I was telling Bruno, I've seen, it seems to me, a solution in search of a problem for the vast majority of the applications. Now, there is one application where there is an obvious benefit, which is cross-border transactions. Now, for the vast majority of cross-border flows are very large. And for very large flows, the frictions are minimal. The cost of, even if you do a wire transfer of, say, 50,000 euros across the Atlantic, the cost is a fraction of 1%. But if you are a small household, for example, an immigrant in the United States who wants to send money back to their own country, and they send $200, $300, $400 a week, the cost is enormous. And I have a table somewhere here, and you see that this, I don't know if you can read the numbers,
1 minute.
but the percentage on the cost of remittances is something that is between 6 and 12%, depending on the pair of countries.
1 minute.
Yeah. And so for these people, having an alternative channel to transfer money that would dramatically change the cost and probably slice it by 4 would be incredibly important. Now, one word of caution, even on this application, actually 2. One is, why is so expensive? So there are various reasons. One is market power, which is the one you would want to break. One is outdated technology, which also this could help. One, however, is anti-money laundering legislation. And so, again, the question here is, how much are we giving up if we completely change the system for international payments? And echoing something that Jean-Charles just said, could we do something else? Can we do antitrust on the intermediaries that at the moment do this trade? Can we do can we regulate banks the way we regulate utility companies or railroads and say, okay, you're not going to extract Visa, MasterCard, you're not going to charge 3%, you're going to charge 1%. And I'll stop there. Thank you.
Thank you, Giovanni. Okay. So, before giving the floor to Bruno and Sara, are there questions, which also from students, from anyone? Try to be short and identify yourself, because then we will questions are to Bruno, or for Bruno, yes. So just identify yourself, and because the report will be published and also the discussion will be part, so we will reconstruct things. So please, and try to be short.
Stable coins, at least retail, CBDCs, at least retail CBDCs are not going to be on blockchain. Stable coins are on blockchain. Stable coins, as was clear from Giovanni's expose, are not monetary creation. CBDCs can be monetary creation. So, I mean, some guys on the other side of the Atlantic have decided to frame the discussion around the comparison or the conflict between those two things. But they're just completely different things, you know? It's just like you say, oh, you have a car, therefore would you like an apple? No, I'm not in, you know? I don't think this is the right question. CBDCs are there for one reason and stablecoins are there for another reason. Maybe CBDCs could be useful as an alternative payment system that could kick in if we had a big problem with the banking system. Stablecoins cannot do that. Maybe CBDCs are a way for the monetary authority to implement a certain monetary policy using different tools. Stablecoins cannot do that. On the other hand, maybe stablecoins can be used to do cross-border payment flows. Fine. CBDCs cannot do that. So it's really two different animals, and I think it's really, really making the debate very confused to always bring them together.
Okay. Other questions from the floor? Okay, maybe I have a couple of questions. So one, actually 3, so if you remember, if you try to remember. One, okay. No, but yeah. So first, 2 are conceptual, 1 is more practical. So you use a lot the jargon of and the structure of incomplete contracts and asymmetric information. And in that, as economists, in that framework, we have a first best. And so the contract is maybe the optimal second best, but so what would be the first best? I mean, conceptually, in that context, maybe it's perfect information, but that is the question. The second, it's very convincing, second question is that now we have 2 bubbles out there. One is the dollar, and the other one is the Bitcoin. But then, which one is better? I mean, if just we created another bubble, so did we really need it? And then with central authorities, so there are pitfalls, as you clearly showed in the presentation, even with the decentralization. But the centralized system has basically a surveillance, as the power of surveillance, in some sense, which works and does not work. Do we need something similar in some sort? But then it's a sort of a paradox.
if we had no market imperfection, and the way I think about market imperfection is a lot about asymmetric information or market power. So if we didn't have those two things, we'd be in the haro de breu. We would not need money, we would not need intermediaries, we would not need finance, or very rudimentary forms of finance. But we are not in this world. We are in a world with information asymmetry and maybe market power. So then the question is the question you're asking, what is the second best? What is the optimal allocation that we can reach subject to the incentive constraints corresponding to the information asymmetry? And I think it's, of course, a very important question. So the theoretical papers I mentioned, the original analysis of, Wicksell and Samuelson, they are actually going in that direction. They're saying, okay, if the market is incomplete, what can we do? And then, of course, there is this generation of very interesting macro models like Bewley, and then these papers. And in those papers, they are having incomplete market, and it's because the market is incomplete that money can be useful. So I like that too. But in the end, being a microeconomist, when you tell me the market is incomplete, I want to know why. So I want to know what is the micro foundation. So what is the information asymmetry problem? So that Jean-Charles and I have been working, Jean-Charles has been working a lot, and I've been admiring the results that Jean-Charles obtained for several years now on this question. And yes, there is a world in which money, like dollar, and taxes will implement a point on the second best efficiency frontier. However, if on top of the information asymmetry, you introduce the problem of the government being non-benevolent, then the allocation we can reach in the end might be very detrimental to the citizens in the economy. So not only will they suffer because of the information asymmetry, they will also suffer because of the predatory behavior of the government. And so that's why I'm going to your second question. You're asking, why do we need two bubbles? And in fact, I think my answer, and Jean-Charles and I have been working a lot on that, is in a sense, the second bubble is competing with the first bubble, and by doing so, maybe is reducing the ability of the government to predate on the citizens.
And then there was a surveillance question.
Oh, yes. Yeah, and it's related to what Giovanni was saying about KYC, and of course, there is also the elephant in the room, which is all these criminals and terrorists who are using Bitcoin to. So that's horrible, and that's clearly a cost associated with the blockchain. I think that here we have a clear trade-off, because if we want decentralization, we don't want the government to hold the keys. And if the government does not hold the key, it's going to be very difficult to do anti-money laundering or KYC. Maybe computer scientists with their genius and the cryptographic marvels they can do could actually help us here, but I don't know how.
Okay, and do you want to reply to some of their remarks in some sense, or? No,
I really want to thank Giovanni and Jean-Charles for reading this very boring report. And thank you so much. I really appreciate, and there's a lot of what you guys said which we will try to take into account.
So Sarah, you want to?
Just want to thank you all, and I hope that all the technical part was understandable, because this is also very hard work to try to communicate between different communities, between economics and computer science. It's really important. Otherwise, it's kind of impossible to figure out how these things really can work and how to predict how they will behave in the future.
Okay. So you want to answer the question, and then we stop?
So I think I had a couple. One. Okay. Let me start with the impact.
2 minutes.
The impact on intermediation of CBDC or stablecoins. Look, the way I see it, CBDC, retail CBDC, to the extent that it's the equivalent of offering a checking account at the central bank, has the potential to increase the collection cost for banks. I don't think it would be a game changer unless you let an infinite amount of money to be deposited in this account. I haven't seen any central bank proposing that. The other thing is that so the real risk here that I was pointing to with stable coins is that deposits that are now universally accepted as a form of payment stop being so. So if you live in that world, then CBDC would be a game changer. Then you would have the central bank have to reallocate these savings somehow, which is complicated in itself. If you don't have that, it's just a cost shift for the banks. So they will have to pay a little bit more interest on deposits. I don't think it's the end of the world. Now, on the other question, which is how we see the risk associated with crypto in the context of crisis, let me give you first the apple pie and motherhood answer that we would give. It is the best defense against that is a well-run monetary policy jurisdiction. So if you have a decent central bank, it's very unlikely that people are going to dollarize. Now, that said, if you don't, dollarization with crypto is easier than dollarization without crypto. First of all, you don't have piles of greenbacks under the bed, which is a risky thing to have. Second, in a run, it's much easier to run through your phone than actually getting your, let's say, politically incorrect pesos and convert them into dollars. That's much harder to do. So everything that happens in a crisis in terms of dollarization is going to be much faster and much harder to control for the government. And they will have to develop, my expectations are that there'll be ways to develop controls for that. I mean, in China, crypto is illegal. You can instruct your cellular companies not to allow apps to buy and sell crypto. Now, this is all going to be very porous, but anti-dollarization measures are already porous. So again, it's a matter of degrees, but it's not, from an economic point of view, it's the same forces and the same problems.
Okay. Jean-Charles?
Briefly, I want to insist on the political economy dimensions of the debates. If governments were benevolent, there would not be any hyperinflation, and there would not be financial crisis, banking crisis, and banks would not extract huge rents from customers. Now we live in the real world where we have all that, and it's not easy to see the best way out. And personally, I'm not entirely convinced that the crypto solution is the best because, as Bruno indicated, some intermediaries and even some governments, like we see in the US, can capture the crypto movement to extract further rents from citizens. So it's not clear to me, but I believe we have to take these political economic considerations always in our minds.
So we start. First of all, I would like to thank the Collegio for inviting me today to moderate this panel at the occasion of the discussion of this very interesting paper that has been presented this morning. Our panel will look at some of the issues that have been identified and described in the paper from a pure policy and maybe a bit practitioner perspective, and trying to also to look at some of the hot issues that are currently under discussion in the payment system world. And I will do too with, my name is, first of all, I introduce myself. My name is Daniela Russo. I am a senior advisor to the executive board of the European Central Bank. I've been in the European Central Bank for 31 years, so since the day it was created, even in the predecessor of the ECB, the European Monetary Institute. And I've done all my career there. I am with two former central bankers, even if now they moved to the private sector. On my right side, I have Franco Passacantando, that I know since long because he has been one of my first boss in Banca d'Italia, in fact, when I joined Banca d'Italia before joining the ECB. And Franco now has also several roles in the private sector, but still as independent board member. And on my left side, I have Jochen Metzger, that I also know since long, since we have fought together some battles at the Eurosystem time to defend the euro and to defend the Eurosystem policy. Also, Jochen now joined Axiology as independent board member, so also there I think it's not a role. And so basically this is a panel of central bankers, because when you have been a central banker for most of your life, even if at the end you move to another area, you remain a central banker. And we were kidding with Jochen that he has still the glasses of a central banker. So you can recognize the style. Okay. So basically what we want to do is to address the two questions of the paper from a policy perspective. The first thing was, can blockchain and cryptocurrency decentralize ledgers, contract, and money? This is the first question. The second question will be the question about integration between decentralized and traditional finance. Before giving the floor to my two panelists, I just would like to point a few things. Decentralized ledgers and contract will not require necessarily decentralized money. So there are some advantages linked to the adoption of new technology and adoption of smart contract in order to make more efficient the execution of the transaction that can be achieved irrespective of the settlement asset that is used. And I'm saying settlement asset and not money, because, as you know, central banks do not like the idea to define money, crypto assets, and stable coins. I think that Jean-Charles has described very well the current monetary system based on the two-tier system, where you have on the top the central bank, whose role is to preserve the integrity of the currency, thereby preserving also the trust in the currency. Bruno said in his presentation, money is not backed as a value because you consider it valuable. You consider it valuable because you trust the currency, and you trust the currency, so because you trust central bank money, because it is a liability from an accounting point of view of the central bank. And you are sure that apart in malevolent countries or malevolent central bank or corruption, or if so, that are, I would say, not necessarily the starting assumption for a theory on the monetary system, and normally you know that you can trust. On the contrary, crypto and stable coins have fragility. In the case of crypto, fragility is obvious because the crypto assets do not have a stable value, almost by definition. The simple fact that stable coins was introduced to try to have the benefits of the cryptocurrency without having the main drawback that is instability. And there are different designs of stablecoins that aim at ensuring this stability. But still, stablecoins continue to present some fragility because it's still exposed to risk, because even if it is fully collateralized by central bank money, it's not a central bank liability. That means that the stablecoins is exposed to the run risk. And the run risk may rise either because the issuer of the stablecoin go bankruptcy, or because, as somebody said in the previous panel, the stablecoins are also traded in exchanges. That means that the value of the stablecoins in an exchange is not necessarily the value at which it is supposed to redeem at par. So this can create problems, the idea of the authority has been that if the stablecoins is properly regulated, maybe there is room to use the stablecoins as settlement assets. And the main requirement of the regulation that was issued in 2021 is that the stablecoins should be redeemable at par in any circumstances. Now, there are some doubts that in a crisis situation the stablecoins will be able to redeem unless the central bank intervene. And this may be behind maybe the recent consultation of the Bank of England on the new regulation of stablecoins, where Bank of England is considering the possibility to provide emergency liquidity assistance to the stablecoins issuer. This will address the problem, will make the stablecoins very close. So say that even if it's not, strictly speaking, money, it can play some of the function of the money as described in the paper. So the stable coins can really, maybe in some economies also crypto, but clearly the stable coins can act as a settlement asset and can act as a reserve of value. So if this is the situation, my question to Jochen is to elaborate on, is it really true that this will work, that they can act, maybe also building on the use cases that are in the paper that Bruno has presented? And do you think that if it can perform this function is more efficient than what we have today? So Jochen.
Thank you, Daniela, and good afternoon. It's wonderful to be here in Torino, and I appreciate that at least some of you have the patience to sit through this all afternoon. And maybe I should clarify one thing. As an ex-central banker, I'm allergic to cryptocurrencies. However, I am not allergic to crypto assets. And for me, Bitcoin is a wonderful crypto asset, but not a cryptocurrency. And after leaving the Bundesbank, I started to work with a startup company, and this is Axiology. And Axiology tries to make money by offering services in the issuance, in the trading, in the settlement, in the custody of tokenized securities. And Axiology is being based in Lithuania. Why Lithuania? Well, this is a very crypto-friendly environment, and it's also very digital and very open-minded. Think of Revolut. Those guys hail from Lithuania. And some of them are still there, and they're supporting Axiology. So it makes sense to, let's say, to think of this as an ecosystem. And Axiology tries to, let's say, serve that ecosystem. So having said that, now going into the use cases, and yes, we have discussed the use case of monetary policy, of store of value, and I can only conclude, yes, you can use crypto assets as a store of value, and it serves as monetary, let's say, policy somehow if you think of the protocol. And of course, I see many shortcomings, and one shortcoming is particularly relevant for me, and this is the connection of credit. You can also say this is public and private money, but this element of credit makes money so valuable. This is why it works, and this is why the economic agents over the centuries, over times, have been willing to tolerate abuse. This is the political economy aspect of it. They were willing to tolerate abuse because the savings of using money were big enough to compensate, let's say, for the abuse most of the times. Of course, there are moments when it doesn't work at all. We call it hyperinflation, but normally, let's say, the economic agents think money does a good job and they use it without thinking too much about it. And yes, crypto assets can fill that purpose. Next thing, of course, next use case is payments. Payments. Can you use it for payments? Is it good to use crypto assets for payments? And I would argue, yes, of course, you can do that. And you have good use cases outside the law, outside regulation. But if you consider, let's say, payment services to be a regulated activity, and in most of the country it is, and for good reason, you need a license to be a payment service provider. And you have a license. Once you have it, you have to, let's say, fulfill operational requirements. And there's also the aspect about infrastructure. Classic infrastructure in payments is very robust. It has been tested. It's withstanding, let's say, high volume, bad times, no power, whatever it is, it keeps on working. Maybe think of using your debit cards, yeah. It works all over the place, your apps on your smartphone. This is all, let's say, new entries to classic payment system rails. In the end, you end up in the classic payment system, and the classic payment does a good job, the classic payment system, to my understanding, when it comes to, let's say, to price and speed. You can use, let's say, alternative payment rails, you can use the crypto rails, and in some cases they are faster and they are cheaper. But those are not the baseline scenarios. Let's say you need difficult jurisdictions. I think our colleague from the IMF has explained a little bit where, let's say, this makes most sense. But let's say in a normal country, in a baseline scenario for the economy, the classic payment system, it's very hard to beat, whether we talk retail or whether we talk wholesale. And maybe this is for me the most interesting use case. This is wholesale payments. This is, let's say, settlement of delivery versus payment transactions. This is settlement of FX transactions, payment versus payment. Or this is, let's say, interbank financial market transactions. And this is where, let's say, classic monetary instruments where they excel. Central bank money, after all, is a risk-free settlement asset. You can use different settlement assets. You could use commercial bank money, but I would argue it's not risk-free. And at the wholesale level, this matters. You could use alternative settlement assets, and you can, let's say, both parties could agree to settle with Bitcoin. Why not? But is this really risk-free? And of course, this then leads automatically into the discussion of stablecoins. You can think of stablecoin, say, okay, we have Bitcoin, yes, it works. I don't mind the principal agent problem. Don't get me started on the principal agent problem. But if you would be not using any agents, it would work very, very well. If you work with agents, let's suppose the agents are licensed. Yes, okay, we can do that. And now let's have a look whether those stable coins could do a better job than central bank money in settlement, in DVP settlement. And as long as we remain outside the chain, I guess the case is clear. Central bank money in its conventional, in its classic version wins. If we go on-chain, the case starts getting interesting because so far, central bank money is not directly available as a tokenized version on the chain. So you could consider, well, as the risk-free asset in its pure form is not available, why not consider stablecoin? But here, I guess, we have to consider something like an intermediate solution. And this is, you probably heard of the ECB trials, to test, let's say, a way of creating DVP transactions on-chain, whereby the payment part resides in the classic payment system, such as Target 2. And when I was still at the Bundesbank, we did the first experiments of this. We called it Trigger Solution. We did this in 2018. And yes, this works. And of course, then we are again talking about using a risk-free settlement asset. However, there are problems in scaling this, in having this really in a mass production. And this is what the ECB project Pontes is all about. Daniela, I guess, will say a few words to this, and I can say Axiology has been participating in the ECB trials, and Axiology is also part of the Pontes working group. And why is this? Because we want to do services in tokenized securities, and we settle against what is available. We would prefer to settle against central bank money, tokenized. Not yet there. Of course, we settle against central bank money provided by an interim solution, such as Trigger, such as Hash. And of course, if, let's say, clients want, we also settle against tokens. However, we prefer to settle against e-money tokens following the EU e-money directive. Those are slightly more stable than the US stable coins, and they're slightly less attractive because they don't offer the same returns to the issuer as the US stablecoins do. So they're something like a, how to say, slightly more stable and slightly more boring version of the US stablecoins. And yes, we settle against them. If we would settle against US stablecoins, I'm not sure whether we would do this, because as a settlement service provider, this would entail extra risk for us. We are not running if we are using, let's say, e-money tokens, which are licensed under the EU law. And I guess if I summarize this all up, when I look at my 3 use cases, the optimum solution for me would be to have central bank money tokenized. Of course, let's say we have already a discussion that we can have the digital euro wholesale, that it should be tokenized, that it should be available on chain. But I want to provoke my colleagues here. I would go one step further. I would ask the question, why don't we tokenize the retail version as well? What is wrong with tokenizing the digital euro retail to make it a checking account on steroids, to give it a, let's say, another dimension of a use case? And if we cannot have the digital currency, the real digital currency, the real thing, okay, we are happy to use whatever is available in order to get it settled, as long as it's supervised and licensed and the infrastructure is reliable. Up to you, Daniela. Back to you.
Thank you, Jochen. I just would, before giving the floor to Frank, I just would like to summarize. There are undoubtful benefits of decentralized ledger and decentralized contracts and use of smart contract. In particular, the fact that through the new technology you can embed information related to different functions which are needed in the payment process in a single token means efficiency gains. So instead of doing one function because you follow the instruction of the FMI, and then you have another thing because you have to follow the anti-AML law, and then you have another one because counterfeiting, and then you have some fiscal thing that has to be done because of national law. So if you can have all this information in a token and then go to different ledger and all these functions are performed at the same time, this, of course, is an increase of efficiency. And in this respect, it's not so important how many intermediaries you have. Because if all the intermediaries act at the same time, provided there is a function, of course, if the intermediary has no function, has to be eliminated, but provided that the thing is processed immediately, and you can do it with the technology and with the smart contract, even if you have 10 performing 10 functions, if the 10 functions are done at the same time with atomic settlement, then I think you will have the benefit. And this, I think, is really something good in the new technology. Of course, for the new technology being able to function properly, it has to be regulated. There are some problems that DLT technology pose, and in particular, there are issues related to governance, for example, to clear allocation of responsibility, to need to be flexible when you have the smart contract, because maybe in a case of a crisis, you may wish to change a protocol, and then who will do it and who will be responsible? But then if the protocol is wrong, who pays if there are losses? So there are issues of finality on which technology is now trying to provide solutions. So there are a number of things that have to be done, but this should not discourage not to do these things and try to reap the benefits. And these are linked to ledger and the contract. And I think that here, unfortunately, the terminology smart contract is misleading. It's been invented by the crypto people, not by you, because they are not contract. So they have no legal value. They should be called maybe more properly automated protocol, automated instruction, whatever gives more the idea on what it is, because contract immediately gives the idea of legal, as if you don't need any legal underpinning, but you will need the legal underpinning, because it's not obvious that the current legal system will support if we don't look at this issue. But again, having said that, there is some merit that can be clearly, and the paper indicates some of these benefits, and this I think is something where clearly there is work to do. But having said that, to have all these benefits, and this is my question of Franco, do we need that the settlement asset is stable coins or crypto? Or this cannot be achieved also, as Jochen was ventilating, with central bank money, maybe in a more risk-free basis, and there are different approaches of central banks. That is why this is interesting.
Sure. Thank you, Daniela. Please, before answering your question, allow me to make a couple of comments with respect to the previous discussion, the political economy dimension of the crypto world and the decentralization. And I want to say that because I also have some allergy to the decentralization, having worked in the central bank, but also because I'm Italian. And why does that matter? Because when I hear about opportunistic behavior, that cryptos could overcome the opportunistic behavior of central banks and governments, I cannot forget that Italy 40 years ago had a central bank which could not set interest rates, who was forced to finance the treasury, whatever the treasury desired. There was was completely submitted to the treasury wills. Had we had cryptos at the time, we would have chosen the road to cryptos, but perhaps we would not have had the institutional developments that we have had in the last 4 years. So when I hear that maybe Lebanon or Algeria perhaps are more inclined to use crypto and that could ensure stability, if I were at the IMF, I would strongly advise not to do that, but to encourage the main route, that is institutional development, to create independent central banks with accountability, with transparency. So that's the first reaction to my first. So cryptos cannot be a shortcut to something that has to be done anyway if you want to develop institutionally and economically a country. Second point, that also because as my friends and colleagues, we have been involved for many years in payment systems. So when we talk, of course, of the risks of centralized infrastructure and centralized world like central banks, of course, when we think at the crisis, the great financial crisis, central banks perform poorly in terms of preventing and also managing the crisis. But if we focus on the payment system dimension of the crisis, we have to remind that the payment system, the classic centralized big dinosaurs payment system, had not suffered any inconvenience, even during the Lehman crisis, and we were there during the Lehman crisis, and so it always went smoothly. So the decentralized component has worked fairly well. What has failed, of course, is in the credit, the asset, the bubble. That was really a bubble, and asset bubble, not the bubble that sometimes you refer to. That I have to understand what you mean by bubble, but. So that is, if we look at the fundamental reasons of decentralizations, I would feel uncomfortable to again consider the rent seeking and also the rent seeking. By the way, you can abolish the primary route to reduce rent seeking is bank competition and also policies that the seigniorage that the central bank gains because of rent seeking should be returned to the state. So those are the. So, but if we leave aside this more ideological and philosophical issue, I would look at the world of cryptos as in pragmatic matters, to see what are the actual benefits that they can provide. And I will come to that. We have 2 rounds of, I will come to that because my second part of my professional life has been at Euroclear, where we are exposed to the tokenization of assets, and we see some advantages of this crypto world. However, still in this more pragmatic, less ideological factor, we have to still think that mostly the crypto world is self-referential. So it's just a world where the stable coins are used to settle cryptos. It's besides all its problems that are legal uncertainty about finality, the energy consumption, and so on and so forth. But it's the main problem why that cannot become a major payment system is because for the time being it's only an inner circle that is. Now it's opening up. There are some indication to open up to the world, and that's where I think the standard intermediaries can play a role. And this will disappoint those who think that the old dinosaurs will soon perish. No, they will not perish, because for the time being, when you trade in financial market, even if you trade with new tokens or with new e-money, you need to trade with the existing assets, existing bonds. So the institutions that allow this communication between the old world and the new world are the central securities depositories, the large banks, the exchanges. So there is. And also, if you look at where the cryptos has achieved the best results in terms of speed, it's on the permissioned cryptos with centralized components. So, sorry, but the centralization comes up again, and sometimes it's also important to make the new world compatible with the old world, to make the two worlds talk to each other. And then I will come to that in the late second round.
Okay, so to close this round, first I would like to add 2 considerations on the centralization of infrastructure to what Franco has just said. The first is related to the creation of CSD. The main reason why securities have been centralized, either dematerialized or immobilized in a CSD, has been the fact to avoid double creation of securities. If you keep the securities in different pool, unless you reconcile continuously, you can move a security and you create artificially securities that will make the chaos in the financial market. So there are reasons that have created. And the other thing that I wanted to mention, that during the Lehman crisis, one of the lessons of the Lehman crisis has been that the markets where there was no infrastructure have been less efficient and less safe than the ones where there is infrastructure. And the typical comparison is made between the FX market and the derivatives market. The FX market has not been so bad because there was CLS, because the CLS was strictly monitored by the Fed. At that time, I was the head of the payment system department in the ECB. There were teleconferences about the status of CLS every 6 hours. And the Fed arrived to a point to force one big US bank to provide liquidity just to be sure that the system was able to. On top, the rules of CLS were very well known ex ante. If you look at the OTC derivatives market, what was the problem? That there were no common rule, there was no certainty on the contract. What has been the result of the Lehman crisis? That several legislation, including Europe with the MIR, have introduced the clearing obligation as a way to conduct to a central infrastructure with common rule to increase transparency. in almost all countries, there has been the creation of a new type of infrastructure, the trade repository, just to be sure that you may have information on both multilateral and bilateral transactions. So centralization is not necessarily something that has to be regarded as negative. On the contrary, in some cases can be a guarantee of stability. And that's why I want to conclude by quoting a sentence of Fabio Panetta, governor of Banca d'Italia, in a speech that he has released in Florence recently, I think the 29th of October. He said, I quote, "Some digital innovation risk, paradoxically, taking us backwards. The proliferation of private digital pseudocurrency outside the remit of supervision can generate financial instability, shift seigniorage to a few actors, and facilitate illicit activities." And I have tried to make a small calculation to show what does it mean, shift seigniorage to a few actors. If we consider that Tether today has issued stable coins for about 170 billion US dollar, so this is given by investors in exchange of stable coins. Suppose that the Tether invests this money at an interest rate of 3%. This generates revenues of about 5 billion US dollar per year. With this money, any payment system can be run. And the seigniorage, the mechanism is exactly the same as the seigniorage. If go to a private entity, that is profit-oriented, will not be the same as if it goes to a public entity that is in charge of preserving the stability of the currency. So having said that, I think we move to the second question, that is how to reconnect decentralized and traditional finance. So I start with Jochen.
Yeah. Thank you, Daniela. The connection to the real world is always a problem. If we, let's say, could simply ignore the real world, we would be very happy on our chain. No further questions asked. However, as, let's say, most of our life is taking place in the real world, and we are having most of the assets in the real world and also most of the problems we want to solve, there is no way around it. And in Germany, for instance, when the discussion on the blockchain started, we had in parallel a discussion on Industry 4.0. And the idea was that, let's say, some services could become viable if, let's say, we could use DLT to, let's say, reduce the burden of administration and to, let's say, make things tamper-proof. Say, connect the sensor to the chain, and if the sensor is a good one, you could measure in, say, machine tools industry. You don't sell a machine, but you sell, let's say, 10,000 cuts with your laser pointer. You sell, let's say, 10,000, let's say, parts that are machined on this. And there were high hopes that this could be used. The industry was thinking, the auto industry say, okay, we can manage our global supply chains by, let's say, putting them on the chain. And chemical industry was thinking about, let's say, their old processes, their relations where, let's say, one company buys stuff from the other as an input and resells the output to the same company, okay, to get this, let's say, more efficient with the chain, and that the only thing that was preventing this was the lack of tokenized money to make the payments. After a while, the discussion petered out because it became apparent that it would take a huge effort to bring those real-world services and problems on the chain, and that the effort required eats away the business case. And if you then go to financial markets, we find something similar. Of course, all assets so far, or 99.9%, are traditional. Is there a business case to tokenize them and move them on the chain? So far, the incumbents, and this is also part of the political economy discussion, see no value in tokenizing the assets and making them available on the chain because they say the current settlement rails work perfectly well. So this leaves you with the new assets. Say, okay, if a bond, for instance, is issued, it's fresh, it's new, there is no legacy, there is no migration cost, you can issue it on the chain. Why not? For instance, the European legislation, the pilot regime, MiCA, MiFID, all this allows for it, and it's done sometimes. I think we have something, could be 3,000 bond issues that have been done, let's say, in a tokenized fashion. However, usually a company does it once or twice. Why is this the case? The case is so bad because normally when you tokenize, you only register the ownership of the bond. Who issues the bond? Who bought it? However, a bond comes with corporate actions. There's a coupon. If you think of equity, you have to pay dividend, you have to invite for a general meeting, and those corporate actions, so far, they are not in the token. It's very difficult to get them digital in the first place, let alone to, let's say, do a smart contract that would allow this for the token. So what happens? You have a token that records the ownership, and for all other practical purposes, you have to rely on the classic custody system. And if you then look at it from an issuer perspective, it's double the cost and less fun, because your token will be illiquid because only very few buyers for the token are available. Therefore, let's say, I guess we need a new approach here, and again, this is publicity for Axiology. Let's say you have to do it all on the chain. It does not make a sense to have a token that just records the ownership of the security. No, the whole contract of the bond needs to go in. All coupons, even redemption clauses, collective action, whatever you have to put it in. And this is easier said than done. This requires, let's say, a lot of effort and a lot of rethinking. And so far, the business case for this does not look so good. And on top of it, this is all regulated. In regulated activities, you have to be careful that you do not get outside the law. Let's say if you're using an agent without a license, this may jeopardize the validity of your contract. Okay, so this is also a clear limitation here. So why don't we seek for blockchain? Why don't we seek use cases that are outside the highly regulated, the highly competitive financial system? Real estate is a case in point, or when we think about financial system, the most arcane and the most inefficient part of the financial system is investment funds. It's the whole thing around investment funds. So why don't we start the tokenization? Why don't we start there where, let's say, the classic system is not working so well? By trying it in the part of the classic system that works very well, this is a big effort. This is, let's say, a very difficult use case. This is very difficult to claim that it works. Yes, it works, but that it works better. No, it doesn't. And Axiology, the company I'm with, is suffering from this. And we try to overcome this by offer, let's say, a full, let's say, suite of services, but still it's difficult. As long as you remain in the crypto sphere, as long as you do not connect to the real world, everything works well. But connection to the real world, to classic assets, to real securities, to real currencies, to real people is a problem. Thank you.
Thank you, Jochen. Franco.
So, if we leave the topic of the use as an instrument, but we look at the crypto for its technology, the blockchain and the DLT technology, I think there are some important elements of this technology that really are shown to be beneficial and so large intermediaries, again, like Euroclear, are looking at it because they can improve, for instance, the settlement finality between reduce the settlement phase, reduce the risk, improve the information, keep the history of the information on the transaction. So there are very, very important benefits that one could show in the application of the blockchain also and in fact banks are using it, many intermediaries are using it. One interesting question is that unfortunately now artificial intelligence is coming to the forefront, and some of these advantages are one has to question whether it's artificial intelligence or DLT. For instance, the fraud reduction in the risk reduction, is it really the application of artificial intelligence has given incredible results, or the DLT? So for maybe you already have an LTI report of 2026, but on 27, I suggest to do one on artificial intelligence and see an application to the financial sector, because it may, but definitely from a technological point of view, there are aspects that need to be considered. And of course, all the major intermediaries are also supporting institutions like the World Bank, the Asian Infrastructure Investment Bank, many banks that are issuing bonds, in tokenized bonds. And so there is a process, there is a tendency to create a tokenization, and to tokenize bonds, to tokenize real assets, to tokenize art. It's crazy. There is so many things that... now, will this still is at an experimental level, but it may grow. And so all the intermediaries, all the major market players in there are trying to create a link, and that's the question that Daniel asked, a link between these new assets and the traditional world. And that's where there is some work being done. If you look at all the big intermediaries like SWIFT, like Euroclear, Clearstream, DTCC, they're all creating platforms that can allow the new tokenized, crypto-based assets to settle, communicate with the standard world. And because the problem here is we talked before, you talked about the importance of a common market, a single market. And there is an importance of a single market, and also the importance of price, a unique price that can sell. But there is also importance of a common pool of liquidity. If liquidity is broken between the crypto world and the rest of the world, you lose efficiency. So the attempt is to create a common mechanism to create a common pool of liquidity. Now, even though all these efforts by individual companies are moving forward, there is clearly a problem of interoperability that unless you have a communication between all these worlds, the liquidity will always become trapped and fragmented. And that's where the BIS has recommended to create links among central banks. The European Central Banks is making an interesting project. There is this project called Pontes, which allows the settlement of crypto-generated tokens in central bank, in wholesale central bank money. And by the way, wholesale central bank money does not need to be necessarily a wholesale CBDC. It can also be the standard RTGS-based wholesale system. But what is being studied is a mechanism that also can generate through the standard RTGS system a tokenized central bank money could settle the tokenized security. So this is, and it's probably in a year time it will become operational. And then there is also another project even more ambitious called Appia that will create a mechanism that will make the whole system work on the unified ledger that could communicate different markets with different technologies that use the different markets. So this need of connecting the two worlds is there, and there are experiments in the direction. But for the time being, we have to live in a world where the two traditional and non-traditional systems will coexist. Thank you.
Thank you. Just two things to complement. One thing is there is potential for tokenization to improve liquidity management for FMI. To the extent that you use atomic settlement and you settle more quickly transaction, in principle you may have more velocity of circulations or more liquidity. But it's also true that you cannot settle gross without pre-funding. So before having the liquidity to use, you should have the liquidity. So many times I think issues of efficiency and velocity are discussed without taking into account that on the back there is the need to have the liquidity for doing this transaction. And that's why one area where tokenization seems promising in order to help liquidity management is collateral management. Because if collateral moves more quickly, then you may provide credit that is collateralized, at least in Europe, more quickly. And so this can support the need for more liquidity, that more velocity that come from the use of tokenization will create. But the problems that Franco has mentioned remain. So on the one hand, there is these transition phases where the old system will coexist with the new one, has the potential to fragment liquidity in an unbelievable way, and is also something that can give stablecoins some competitive advantage, because if the other settlement assets are not tokenized and will be used through traditional system, then it's true that the velocity of settlement can be different, even if risk-free. And so this is something that will need to be carefully looked at. And the other thing is that too much decentralization may again create fragmentation of liquidity, because then you will need a lot of pool to support the different blockchain if they are not interoperable between themselves. And this, of course, risks to be a major issue that will need to be addressed. And similarly, the IMF and the World Bank are looking with interest to some new type of transaction that can be performed thanks to the tokenization, that are the so-called P versus P versus P, multi-leg transaction, that is our FX transaction that incorporates the liquidity funding transaction. So suppose that you need the dollar to buy euro and you have I don't know, UK pounds, then you go to an intermediate, to a facility that can be an automatic facility, so not necessarily an entity, that will convert your pound into dollar so that you can buy your euro. It's unclear how this facility will be designed, regulated, and whether they will be outside or inside the relevant infrastructure. Because if they are inside the infrastructure, so if they will allow to introduce transactions that are already covered, so where you don't need to do funding, this will be an improvement. But if they are outside, again, the risk of fragmentation of liquidity is big. And that's why these issues are very complex to address. But of course, so there is a lot of potential, and will be a pity not to use it simply because the issues are complex to address. All this, for us regulators, translating the need to maybe provide guidance on how existing standard for traditional FMI should be applied to FMI that use tokenized assets. And the central banks, together with the securities regulators, which are in IOSCO, may wish to look at this issue soon. Thank you.
Maybe we cannot conclude this session without thanking the author of the paper.
It seems like they want to react.
Because it was a very, very useful paper, and yeah, okay, but I just wanted to congratulate. Thank you.
Thank you so much to you three. It's so important for us who are poor academics to have the honor and ability to interact with real people. You know, you were talking about the real world. You know, what is it? So thank you for being the real world for us.
Now, let me just say that the process is long, as Bruno says, so I'm happy to. We have the next panel will be next year will be with Pierpaolo Benigno and his brother. They are not the Blues brother, but they are a bit of them, and will be the role of the dollar in international financial system and its future. So in a year time we will be here. So thanks again for everybody, and especially to Florence, which all of you have interacted, and also Luca. Yes, she deserves it.